Well, good afternoon, everybody. Welcome to this week's Market Huddle. I'm Joe Lucey, Certified Financial Planner. Most of you already know who I am. The founder, CEO, and such of Secured Retirement. We work with families in and nearing retirement. And we have a comprehensive approach. I'm excited this week because we have Tim Sargent, who is the Director, Chief Investment Strategies with Sterling Capital. Many of you know Sterling. They're a more recent money manager that we've added, but they've had some tremendous performance. I'll go into that a little bit, and then I'll let Tim kind of share with you a little bit more about their process and the way they see things, even a little bit more about this. While they've had a very impressive last couple years, kind of where they see things this year, where do they see things going forward, and what have you. And then we have some party favors here today. I'm going to make sure that everybody can walk away with a 2-page report that Sterling puts out, a little bit about their company, so you can do a little bit more of your own research, and everybody gets an opportunity to schedule some time with one of the advisors here, whether you're a client or you're just kind of joining us maybe for the first time. Somebody might have sent you some information about these market huddles, and maybe this is your first time visiting with us. Everybody's eligible to schedule that review. If you're 15 minutes is generally a good phone call, but if you'd like to schedule more time, of course, we can always make sure that that happens as well. So with that said, excited to have Tim on. Welcome, Tim.
Thank you.
All right. So let's move on here. This is our disclaimer. It's the same disclaimer we've been doing ever since we started our market huddles back on March 18th. That was the market bottom after the coronavirus locked everything up. Dow was about 18,500. As we're kicking over 30,000, it's definitely had a tremendous move. Tim's Sterling Capital has participated very healthy, very well with that move, and I know that he wants to talk a little bit about that here today. Good afternoon, Steve. Welcome, and thanks for joining us. And I got Michelle there letting me know that everybody is staying warm. So here are some numbers, and hopefully everybody can see this. It gets a little bit hard for me to see as I'm presenting these, but if you look here just to last year, Sterling Capital had almost a 38% return last year. The year before, 2019, they were up almost 44%. So combined, if I look at the last 3 years, they are a company or an investment manager that has been averaging 27% over the last 3 years, going back to inception. I'll let Tim talk about how far back that goes. 24%. So they've had a tremendous return, definitely outperforming most of your market indices. And the way they do that is with a concentrated portfolio. What they look at is basically all capitalized companies. They buy a portfolio of anywhere from 15 to 30 positions. They have a low turnover, and they're buying more growth-focused investments that are changing the world. Things like, maybe some Google, Amazon, and I'll let Tim talk a little bit about that. So here's Tim here, and a little bio on Tim. Tim's been with Sterling Capital for about 16 years. He's been in the financial industry for going on almost 25. He's resides out of Raleigh, North Carolina, and that's where he's joining us from here today. Tim's cover page, and then the disclosures that Tim has. Keep in mind as we go through this, any past performance cannot indicate any future results. That's kind of, as we talk about numbers, there's no guarantee that that'll go forward, and I'm sure that some of you will have questions about that near the end of the presentation. So for the most part, Tim, we discussed having Tim do maybe 10 minutes or so, talking a little bit about Sterling, what separates them, why you might want to consider them as one of the money managers that we work with your portfolios. And then we'll do a short Q&A and try to, again, I'm going to have some, I'll make sure that everybody gets an opportunity to get some information and more about Sterling if you'd like to do that and can schedule a meeting with us. So without any further ado, Tim, well, here's some technical terms. Tim, I'm going to let you take it over from here. And again, welcome. Thanks for joining us. And what do we want to know about Sterling, and what do you guys see for Sterling into 2021 here?
Yeah, Joe, first of all, thank you very much. Really appreciate you having me on. And then everyone who's joining us on the call, really appreciate your time as well. So thank you all very much. Just quickly, who is Sterling Capital? We're north of an $80 billion institutional money management on risk management. We're headquartered in Charlotte, North Carolina. When I say institutional money management, what do I mean by that? Well, if you take a look at who our clients are, I think that tells the story. We manage money for Adobe. We manage money for Amazon. Even though I live in North Carolina, I did grow up in the great state of Ohio, so we manage money for the Ohio State University. So we really manage kind of the who's who of corporate America, certainly public institutions, states, large pools of money, but they can essentially hire anyone in the world to manage their dollars. And they've chosen us at Sterling Capital. And we take a lot of pride in that. And the reason that I bring that up, candidly, is because it's the same intellectual capital working on those portfolios, working with Amazon, working with Adobe, so on and so forth, that are working on your portfolios, right? We still have the same capital market assumptions, the same idea of what's going to happen with inflation, interest rates, the equity markets, so on and so forth. So that's who we are in a brief thumbnail. With that being said, let's take a look at what we think with the economy and why we're still excited for a 2021. So kind of looking at 2021, 2020 was, we'll call it an interesting year. It's the old, I guess it's the old curse, may you live in interesting times. Last year was certainly interesting. This year we think is going to be much more tame. I guess I'll start with the summary. We actually believe that stocks are going to have a positive year in 2021. Now, we do think that the returns are going to be a little more muted than maybe we've seen over the past couple of years. Certainly, Joe highlighted some of the strong numbers that we've been able to put out. We think that the indices as a whole, like the indexes, are not going to have those types of robust returns. But we do think there are going to be pockets of areas where we can tilt the portfolio to make sure that we're capturing the gain. So we are positive on equities. We're just not quite as bullish as maybe years past with what the year-end return is going to look like. So with that being the case, let's talk a little bit about why we think that. Certainly you have to take a look at earnings, and you have to take a look at the fundamentals of the economy. We're going through Q4 earnings right now, and candidly, Q4 earnings have been very, very strong. North of 80% of companies that have reported earnings right now are actually beating earnings. And so that has been a very positive as we are heading into, February already. Looking at the economy, what do we expect for the year? We do expect 2021 to be a largely positive year with GDP, specifically in the back half of the year. We had a huge market rally in Q4 of last year, really with the vaccines that have come out, and we are seeing those getting distributed at roughly 1 million per day. I can tell you my wife is a nurse. She's already had both rounds of shots. So as more and more people get the shots, get vaccinated, we are going to see a normaling of the economy in the market as everything opens up. We do think that's going to be led by the healing labor market, a robust housing and construction, and really a consumer that's relatively healthy. And we'll talk about that in just a few moments. Looking at what the Fed is going to do, really we think the Fed, which is the Federal Reserve, is going to continue being a backstop and continue pushing liquidity into the market. We think that they're going to keep interest rates at the short end of the curve very low. We'll talk about that in more detail in a moment. And then certainly we have a new sheriff in town, so to speak. I'm not going to get too political, but we do need to address the fact that we do have a change in administration, and we have complete Democrat governance with the House, the Senate, and the presidency. We do believe that some of the more progressive policies, because it is such a narrow lead, might not get pushed through. And the hope is this could be more of a centrist type of a governance over the next couple of years. So let's look at some charts, because who doesn't like charts, right? So if you're looking at the economy, what I would say is the economy is healing, right? It's absolutely healing. And you can kind of see the V-shaping. If you look kind of at the bottom right over here, you can see the unemployment rate is certainly recovering in a very quick fashion, much quicker than a lot of the pundits said it could happen when the COVID crisis hit. If you take a look here at the upper right, it takes a look at productivity and production. What is interesting is the blue line is the production, right? So certainly we had a big drop in production when the economy shut down, but apparently we all like working from home, because you can see as workers, we are becoming more and more productive working remotely. So that is something we find interesting as well. Looking at the indicators, we think it's very important looking at leading indicators to tell us a glimpse into the future, what's going to happen. So the leading indicators we like to look at are initial jobless claims, manufacturing, then housing. Then you get to the coincident indicators, which tell us what's kind of happening right now. And then lagging indicators tell us what happened in the past. And it's certainly great to have a good handle on all that is involved, but the leading indicators are still moving in the appropriate direction. We did get a little bit of a disappointing initial jobless claims the other day. However, it is still moving in the appropriate direction, just not as rapidly as we had seen before. Looking at the manufacturing, the two bullets there, ISM manufacturing and ISM non-manufacturing, essentially anything above 50 is growth, and anything below 50 is contraction. And as you can see, ISM manufacturing is at 60.7, so certainly squarely in growth mode. However, we are not necessarily a manufacturer export-based economy the way like a Germany or a China is. We're more of a non-manufacturing, service-oriented. So if you see the non-manufacturing number at 57.2 is very strong as well, right in growth mode. So that tells us that the economy, again, is certainly moving in the appropriate direction. And for anyone who asks, what the heck is ISM? It's simply the Institute of Supply Management. I don't want anyone to get hung up in some of the jargon we use here. The good news is it's good news. And then looking at housing, housing is just booming all over the country. Certainly here in Raleigh, North Carolina, you can't drive more than like 5 minutes without tripping over new buildings, new houses, and so forth. In fact, the joke we have here in Raleigh is we can't believe anyone still lives in New York and New Jersey because they all seem to have moved here. In fact, we have a town named Cary. It stands for Concentrated Area of Relocated Yankees. Certainly, I am guilty of that since I grew up in the great state of Ohio. But since I've been down here so many years and raised my daughters here, I do feel like a native, I guess, at this point. But the takeaway from this slide right here is even though the economy is not exactly where it needs to be, all the leading indicators are telling us it's moving in the right direction, and that's a very positive note for 2021. I don't want to spend too much time on the yield curve. I just want to make sure I had it here. We actually like stocks more than we like bonds in 2021. The reason for it is we do think inflation is going to creep into the economy a little bit, and how that really manifests itself is, let's see if I can highlight this. Nope. Hopefully you can see, here we go. How about this?
I don't think, oh.
There we go. So the short end of the curve right there is where the Fed controls it. We hear the Fed raising rates, lowering rates, and so forth. They're going to keep rates basically there through the end of the year. Where inflation kind of creeps in is kind of the longer end of the curve, kind of out here, 10 years plus. And what we're going to see is higher interest rates, in our opinion. So what we're doing there to protect on the fixed income side is kind of shortening up our duration, taking some of the interest rate risk off the table. And I'll say we think we're going to have a little bit of inflation. Don't worry, we're not calling for anything bananas. We just simply think that we're going to see some of it creep in simply because the obvious side effect of what the Fed's doing in Washington, D.C., a lot of money into the system, is they're trying to cause a little bit of inflation. We think that's going to happen. But how do you keep ahead of inflation? You own equities. And we think that we do a pretty good job of it. Looking at the unemployment rate, I always love looking to a picture of America. It's a beautiful country. You can certainly see where you are, where the unemployment number is. but as a country right now, we're roughly at 6.7%, which isn't fantastic. But when I went to business school back in the early to mid 90s, I was actually told 5% unemployment is full employment, meaning 5% of the country is just never going to work. Certainly, we have proven that wrong. So I can go back to my old professors and I guess taunt them a little bit. But at the end of the day, certainly we think that as we open the economy with the vaccines, that we are going to see improvement in employment, which we think is going to improve the economy, which gives us optimism with equities, meaning stocks in 2021. I talked a little bit about what the Fed's doing. You can kind of see the kind of spike in 2020. Certainly, the Fed is pumping a massive amount of liquidity into the system. And both Joe and I have been doing this for a long period of time. And I won't put words in his mouth, but folks like us have been doing it for a while. We always say, don't fight the Fed, right? The Fed always wins. So certainly we think that with the Fed pumping so much into it, Janet Yellen, the new Treasury Secretary, used to be the chair of the Fed. So we think there's going to be a united attack with DC and the Fed towards the economic situation we have right now. Again, that gives us economic good vibes, and we're feeling very positive as we run into 21. Inflation's tame, under control. Certainly, the Fed's probably going to let it run a little hot, a little long. They said they want around 2%, but instead of just hitting 2 and then pumping the brakes, they're going to have it average 2%, which is a way that they're going to let it run a little bit longer, simply to allow the economy to heal. Again, nothing to be overly concerned about. Just want you to know that we keep our eye on this and make sure that we are investing the dollars in the appropriate manner. So with that, I quickly ran through who we are. I quickly talked about the economic update, which is the economy is healing. We think that it's going to continue to heal. We think it's going to be a positive GDP year. Specifically, second half of the year is going to be strong. We're a little bit cautious on bonds, and we are optimistic on stocks here in 2021. Joe, back to you.
No, I appreciate that. What I'm going to do first before we start to take some questions, we got some time for a little Q&A here today, is first of all, I want to share with you a 2-page document of front and back. It's 1 page, 2-sided document. It's the Sterling Capital fact sheet that's early on when I showed you the numbers. It's through December 31st. Something you can download. If you'd like to download this, go ahead and download it. You can review it, do some of your own research on Sterling, and then reach back out to us, and we can talk to you a little bit about that and how it would fit into your own personal portfolio. I'm not a big fan of everybody necessarily just because we have Sterling on. Not everybody should be looking at Sterling for their portfolio, but I know that a lot of our clients are using this as part of their overall strategy and have been very pleased. It's a position or a money manager we just started working with in the fourth quarter of last year, and the results have been pretty good. With that said, Tim, I think maybe a couple things I wanted to make sure we addressed, and also answering any questions that come up. So if you have a question, just go ahead and put it into the chat box there, and we'll make sure that we try to address that. The election, Tim, that's probably the most common question I have. What should I be thinking about the election? Is our tax rates going up tomorrow? How is that going to change the way that we should be looking at our investments and what have you? So, Tim, what are your thoughts? I mean, and I agree with you, by the way, with don't fight the Fed. The Fed is definitely putting a lot of stimulus in the market. But overall, what do you think about the election and how that may change the way that you at Sterling Capital are selecting investments?
Yeah, that's a great question, Joe. So certainly we're going to have a significant change in policies, and we are seeing that manifest itself, right? We've seen a record number of executive orders kind of undoing the administration. So some of the things that we think are going to happen, we're keeping our eyes on. We think there's going to be some headwinds, and there's going to be some. So let's start with the headwinds or some of the potential roadblocks that we see. Feel that taxes are probably going to go higher. The reason for that is that's what the president ran on. So with that, if less money, then you have less money as a consumer to go out and spend. And then also, if you raise the corporate tax rate, essentially what happens is the classic way to value a company is by future cash flows. And if those future cash flows are worth a little bit less because they're paying more in taxes, voila, you have lower valuations. So the taxes are a little bit of a headwind. We think that there's going to be more regulation that is going to prop in, and we could potentially see higher energy prices. All those things could be a little bit of a headwind for equity. However, on the positive side of the ledger, that's never seen a stimulus package it did not like. So we think that there is going to be significant spending, which Wall Street likes, at least in the short term. And certainly we think that there's going to be an infrastructure deal. It would most likely look different than maybe an infrastructure deal under the prior administration. However, again, it goes back to Wall Street likes the spending. We have some sort of long-term ramifications for the spending at some point if we can't get the fiscal house in order. But right now, we think it's going to be net positive, although there are going to be different industries that are going to be probably a little more favorable. But that's part of the ebbs and flows of Washington, D.C. And why we really kind of look at the fundamentals of an economy, of a company, and want to make sure that regardless of who is in, that they should continue to produce and achieve the goals and objectives that they've laid out. That's a great question.
One of the questions that came across here, Tim, was from Mike. He's asking about Sterling's view regarding commodities, and maybe we can even expand that a little bit. I know you do have some exposure to, like real estate. Are there currencies, Bitcoin, or what have you that you guys are looking at? What are your thoughts as far as commodities and some of the other alternatives out there?
Sure, that's a great question. With regard to commodities, really commodities are, we think, going long in. So what I mean by that is, let's say, for example, you want to buy gold. That could be a great investment, and maybe it's for you, and maybe not. But looking at gold specifically, what I can say is that it doesn't produce an income, and it doesn't produce a gadget or a widget or something that it sells or other people can download and use. So essentially, when you buy gold, you're assuming that someone's going to be more fearful of the economy at some point in the future than you are now. And certainly that can happen. And we have certainly seen times when commodities, specifically gold, has done well. But we think that there is going to be some inflation. We had talked about that. So that will probably push commodity prices a little bit higher. I mean, certainly that's what inflation is. So we think that we are going to see some rise. However, we do favor equities right now over commodities, generally speaking, as asset classes. Great question.
Sorry about that. I muted myself and I wasn't doing very well. But your answer, very Warren Buffett-ish. I mean, I think Warren Buffett was one of the folks that has some very famous lines about investing in gold and how people like to dig holes so that they can guard this and what have you. And if you're looking for some information on what Warren Buffett says about gold, it's a good exercise to Google. And then one of the other areas, if I don't see any other questions, you're talking a little bit about what you've seen so far year to date with Sterling, because Sterling is. There may be some opportunities out there for somebody that is looking for a good time to enter. And so talk about Sterling and where you sit now, and then I'll come back to Tim's question here in a few minutes.
Yeah, sure. So certainly the beginning of the year, we'll call it just a little bit choppy. The first part of the year, small companies like your smaller type firms really did well first couple of weeks of the year. We certainly saw some craziness go on with GameStop, and I guess we'll call it the small Reddit investor versus the hedge funds and so forth. So certainly has been a very interesting year. But with that being said, again, we're very optimistic that we're going to have a positive stock market for the year. We do think that there is opportunity to get in. Certainly, we'd want to make sure that you're sticking to whatever plan. Joe, that's exactly what you do. You're an expert on that. I mean, shoot, you have the highest certification for it with the CFP. So as long as it allows for the plan, we think equities are a great place to be in. For all the reasons I talked about before, we have the Fed we have spending from DC, and then the fundamentals of the economy. All the leading indicators are moving in the appropriate direction. And then certainly we're going to see an opening up of the economy as we all get vaccinated. So I don't want to act like this. I have rose-colored glasses on and everything's perfect. There is going to be volatility throughout the year, but we firmly believe that we are going to have a positive year. Conversely, we're a little more cautious on bonds. So if you're looking for a place to invest, your options are stocks or bonds. We would, again, given what your plan is and working with Joe, we are much more optimistic on stocks throughout 2021.
A couple other questions coming in. I think Kurt has a good question here, and probably one that you can answer fairly quickly. But talk about any kind of hedging or shorting that Sterling does, or are they just purchasing long and what have you?
Yeah, so that's a great question. We don't implement shorting. And for those on the call who don't necessarily know what shorting is, traditionally you buy a stock at 50 and want it to go to 100. If you want the stock price to go high, that's called going long. If you're shorting, you buy a stock at 50 and you want it to go to 25, right? You make profits as the company or the stock price goes down. That's called shorting. We do not implement any shorting type investment strategy in any of our portfolios. We sometimes will hedge, but if we're going to hedge, a lot of times that's going to be certainly not focus equity, but in some of our strategies, we might have some national holdings, and you're going to want to have some currency hedging or some underlying, you might have some currency hedges on, just so you don't have to worry about that. But yeah, we're not huge fans of leverage. We're not huge fans of hoarding. We certainly use the investment tax strategy we want, but we want to make sure that I mentioned we're a risk manager, and leverage is great and isn't. And we just want to make sure that we make our returns the old-fashioned way with hard work, trying to buy the right securities and add alpha that direction. Alpha return.
So staying a little bit away from some of the GameStop investments that were going on the last few weeks, huh?
Yeah, exactly. Right. I mean, it was good till it wasn't.
So Tim asks a little bit about inflation, energy costs, regulatory tax increases, consumer confidence, government overreach. Does that combination cause any concerns for you at this point as you look at your portfolio? And maybe we can bring that out past just the next 12 months, but let's say over the next 3 to 5 years. What are your thoughts or Sterling's thoughts on some of these areas?
Yeah, certainly. And I think I mentioned some of them as headwinds, right? Higher taxes, I kind of walked through why that's a headwind with equity. So certainly that would be an issue. Regulation, I live in a very highly regulated environment. So every hour that I spend doing that type of stuff certainly is an hour that I'm not productive doing my job. So certainly that would be a headwind with regard to productivity. With regard to energy prices, I live down here in North Carolina, so forgive my, redneckness at this point. But what I can say is if I'm driving my truck around and I fill it up for $50, I have money to walk into the Stop and Rob and buy some beef jerky or something for the drive home. If it all of a sudden costs $100 to fill my truck, I'm not going to go into the Stop and Rob and buy anything, right? So it's a tax that gets put on every single consumer with higher energy costs, and it's a tax that goes into everything that gets shipped across the country. Again, I talked about how housing's booming everywhere. Well, you can't drive through these darn neighborhoods without almost running over or running into some sort of Amazon truck these days. Right, so higher energy costs are going to absolutely cause higher prices and so forth, which is certainly inflationary. And then the question is, how much of it are the companies going to be able to push on to the consumer, and how much of it are they going to have to eat? Companies like profit, so if they have to eat too much of it, that could actually end up hurting employment because then maybe they let some people go. So certainly those are some headwinds that are out there. Certainly it's something that we keep a eagle eye, close watch on. But with that being the case, we do think that there's going to be significant spending, and we think that spending will kind of outweigh, at least in the short term, some of the other issues. And then certainly capitalism is boss. Maybe the person that you want to win did not win in the most recent election. But what I can say is the market went up under Bush, it went up under Obama, it went up under Trump, and we think it's going to go up at least this year under Biden. And most people who voted for one of those did not vote for the other on the other side. So capitalism is boss, capitalism is undefeated, and we certainly feel very optimistic. And I've got two daughters, one in college, one in high school, and I certainly am working as hard as I can every day to make sure that their lives are better than the lives that I had. And I've had a pretty darn good life.
You know, Tim, I want to thank you for taking some time to sharing with us a little bit about Sterling. Everybody you should be able to download a 2-page report there. If you don't see that, the number for our office is in front of you. You can always email us at info@securedretirements. We'll get you the report. In addition to that, what I wanted to make sure we did is offered everybody the opportunity to schedule 15 minutes with somebody on the team here, review your own personal situation. So hopefully you see a way to do that right now. That immediately goes to our calendars, and you can get put right on, and we can schedule this 15 minutes. Whether it's talking about Sterling or just talking about your overall portfolio composition. Right now, we have a lot of families with the market hitting all-time highs, asking us to rerun the portfolio EKG that many of you have had. It's basically a stress test against your current portfolio. What would we expect to see for volatility in that portfolio if we were to slow down again with the coronavirus, or maybe if as interest rates rise, we shouldn't show you what that would look like. Come back, look at the overall income strategies. You know, most families aren't hiring us just because they have access to somebody like Sterling. They hire us, number one, because they want to make sure that they can live on the income they've become accustomed to in retirement and can spend in confidence. Number two, it's about tax planning and reducing taxation. And then the third is if we can partner with somebody like Sterling here to grow your wealth without compromising the income or the tax planning we do, that's what we look to do. So if you'd like to spend some time talking a little bit about Sterling, how that might fit into your own personal situation, your own strategies, schedule the time right there. Let's spend some time, review download that 2-pager there, and reach back after you've done that as well. We're here as you need us. We want to make sure that we're constantly creating value. So let us know how we can do that. Couple housekeeping items. Number one, there will be no market huddle next week because of the President's Day longer weekend. I'm going to let some of the team go and spend some time with their family, or maybe even get a little bit out of the cities here on a short trip or something. But so we will not be doing a market huddle next week. The other thing is that many of you that are clients were in the process of reviewing or just trying to figure out how we can create more value for our clients and make sure that we're doing everything we can. So if you are a current client of ours, you probably have received a survey recently. It's from a group called Nexa. And if you have would be so kind to review that, fill out if you haven't done so. It doesn't take that long, but we're really going to be focusing over the next 12 months on how do we create more value? How do we make sure that we're delivering what our clients want? And that's a great way for us to identify that. So if you have not filled out your Nexa survey, I would greatly appreciate if you could do that for us. It'd be a huge favor. With that said, Tim, I wanted to thank you for spending some time with us here today. Any parting thoughts before we wrap things up here?
No, just quickly, I want to reiterate my gratitude. Thank you, Joe, very much for the opportunity to talk today. Everyone on the call, thank you very much for listening. If there's anything I can do to help, please let me know. Joe, thank you so much. Have a wonderful, wonderful day.
And thank you, everybody, and I hope everybody enjoys the rest of your week. And with that said, I'll go ahead and sign off here. If you have somebody you'd like to forward this to, I believe that we're going to be sending this out here to everybody that attended it. In fact, I think we do it for the pretty much everybody that's on the list. So as you get that, feel free to forward these on. If you've got somebody that is looking for, has questions about the direction of the markets, or maybe it's somebody you think would be a good fit for secured retirement, feel free to send off the recording of this. And with that said, everybody have a great week and have a great day. Take care, everybody. Bye-bye.